Here is your complete voiceover script. While Malaysia is busy celebrating its latest highway projects, Indonesia just quietly approved the largest infrastructure spending plan in Southeast Asian history. And nobody in Kuala Lumpur is talking about it. But they should be, because what Indonesia is building right now is not just roads and bridges. It is a direct threat to Malaysia's economic position in this region. Stay with me, because by the end of this video, you are going to see something that most analysts are completely missing. This video is going to show you exactly what Indonesia is building, why it is happening right now in 2026, and what it means for Malaysia's future. Not the version governments want you to believe, the real version. Before we go any further, I need to ask you something. My friend told me this channel would never grow because topics like this are too deep for most people. I want to prove him wrong. If you believe that understanding what is happening around us actually matters, hit that subscribe button right now and let us build something real together. Assalamu alaikum and welcome back. Let us start with the numbers, because the numbers are what make this story impossible to ignore. In 2025, Indonesia announced infrastructure investments totaling over $400 billion to be deployed across a 5-year period. That figure is not a projection. It is a committed budget backed by both domestic funding and foreign direct investment from China, Japan, South Korea, and the Middle East. For context, Malaysia's entire GDP in 2024 was roughly $430 billion. Indonesia is spending nearly that amount just on building things. Now here is where the loop opens. You might be thinking, Indonesia has always talked about big infrastructure. They have been promising this for decades. So what is actually different this time? Hold that question. We are going to answer it, and the answer is going to surprise you. Let us go back a little. For most of modern Southeast Asian history, Malaysia had a structural advantage over Indonesia. Malaysia's infrastructure was simply better. The roads were smoother, the ports were more efficient, the logistics networks were tighter. This made Malaysia the preferred destination for manufacturers who wanted to serve the region. Companies setting up factories chose Malaysia not just because of tax incentives, but because goods could actually move in and out reliably. That reliability was Malaysia's quiet superpower. Indonesia, despite having 280 million people and the largest economy in Southeast Asia, was always held back by geography and poor connectivity. 17,000 islands, limited port capacity, roads that turned cargo journeys into nightmares. An investor wanting to move products from a factory in Java to a buyer in Sumatra sometimes faced delays that made the whole operation unviable. So even with its massive market size, Indonesia kept losing manufacturing investment to smaller but better connected neighbors. Malaysia understood this and benefited enormously from it. But now something fundamental has shifted. And this is the part that should make every Malaysian pay attention. Indonesia is not just building more of the same, they are building smarter. The Nusantara Capital project in East Kalimantan, which many people dismissed as a vanity project, is actually anchored to a massive surrounding infrastructure corridor. New toll roads, a deep-sea port with 4 times the capacity of anything previously in the region, a rail link connecting the new capital to existing economic zones, and critically, a logistics hub designed specifically to attract the kind of advanced manufacturing that Malaysia currently dominates. The port alone changes the calculation. When manufacturers talk to logistics advisors about where to place their next facility in Southeast Asia, port access and shipping time are always in the top 3 factors. Indonesia is about to have a port that can compete directly with Port Klang. When that happens, the conversation changes. Now remember that question you were holding? Why is this different from all the previous Indonesian infrastructure promises? Here's the answer. 2 things are happening simultaneously that have never happened before. First, Indonesia's government has tied infrastructure funding directly to foreign investment guarantees. Meaning, the ports and roads are being built in coordination with confirmed factory investments, not before them and not after them. The chicken and the egg problem that killed previous Indonesian infrastructure plans has been solved. Second, global supply chain restructuring after the disruptions of the early 2020s has created a window that will not stay open forever. Multinationals are actively looking for new manufacturing bases right now. Indonesia is presenting itself with infrastructure, labor cost advantages, and a domestic market of 280 million people all at the same moment. Malaysia cannot offer that combination. Malaysia's labor costs have risen. Its domestic market is 33 million people. And its infrastructure, while still strong, is no longer uniquely strong. This matters for Malaysia in a very specific and painful way. The electronics and semiconductor supply chain has been Malaysia's crown jewel for decades. Penang is one of the most important tech manufacturing hubs in the world. Companies like Intel, Infineon, and Bosch have had operations there for 30 years. Malaysia has trained engineers, established supply chains, and built an ecosystem around this industry. But ecosystems are not permanent. They shift when conditions shift. Right now, Indonesia is in active conversations with several major electronics manufacturers about establishing production facilities in the new Batam and Bintan special economic zones, which sit just across the water from Singapore and well within range of Malaysia's own industrial corridor. These zones are being upgraded specifically to host the kind of precision manufacturing that Malaysia thought was safely in its corner. And here is the contrast that should sit uncomfortably with you. While Indonesia is announcing new economic zones with streamlined foreign ownership rules, Malaysia is still navigating bureaucratic approval processes that international investors consistently rank as slower than regional competitors. One logistics executive interviewed by a regional business publication described Malaysia's investment approval timeline as, and I quote the sentiment, not the words, predictable but not fast enough for the current moment. Speed matters when the window is open. Indonesia is moving fast. Malaysia is moving at its usual pace. Let us talk about what this means for ordinary Malaysians, not just for governments and corporations. If manufacturing investment shifts toward Indonesia at scale, it affects employment in Malaysia's industrial states. Selangor, Penang, Johor. It affects the ringgit's stability because foreign investment inflows help support currency value. It affects the government's ability to fund public services because a thriving industrial base generates tax revenue. These are not abstract consequences. They land on real people. Here's another loop that has been sitting open. We mentioned that Indonesia is receiving investment from China, Japan, South Korea, and the Middle East. Why would all of these different players be moving at the same time? The answer is that each of them has a different reason, but they all point to the same direction. China sees Indonesia as a manufacturing base that lets Chinese companies access Southeast Asian and global markets while reducing exposure to trade restrictions targeted at China directly. Japan and South Korea see Indonesia as a supply chain redundancy location, a backup for production that currently runs through China. The Middle East, particularly UAE and Saudi sovereign wealth funds, sees Indonesian infrastructure as a long-term asset with strong return potential as the country industrializes. When all these motivations align around one destination, the investment is not speculative. It is structural. Malaysia needs to understand that it is not competing with a poorer, less developed Indonesia anymore. It is competing with an Indonesia that has learned from its own failures, secured serious capital, and identified exactly which industries it wants to win. So what should Malaysia do? And is there still time? The honest answer is yes, but the window is not wide. Malaysia's strongest card is still its existing ecosystem. 30 years of semiconductor expertise does not disappear overnight. The engineers are here. The supply chains are here. The institutional knowledge is embedded in companies that would face real cost to relocate. But Malaysia needs to use that advantage aggressively rather than assume it will hold passively. That means faster investment approvals. It means doubling down on technical education so that Malaysia keeps producing the kind of talent that high-tech manufacturers need. It means being honest about where gaps exist and closing them before Indonesia closes them first. The worst outcome for Malaysia is not losing to Indonesia. The worst outcome is losing while not noticing it is happening. Because by the time the data makes it obvious, the manufacturers will have already decided. So here is what you need to take away from this. Indonesia's infrastructure boom is real, it is funded, and it is strategically targeted at the industries Malaysia depends on. The window where Indonesia was held back by poor connectivity is closing fast, and Malaysia's response so far has been too slow and too comfortable. If you are a Malaysian watching this is not a reason to panic. It is a reason to pay attention. Share this video with someone who needs to hear it. Leave a comment telling me whether you think Malaysia is moving fast enough. And if this kind of analysis is useful to you, subscribe because we are going to keep watching what our neighbors are building while most people are looking away. The region is changing. The question is whether Malaysia changes with it or watches from the sideline.